Good evening, everyone. I'm Jerry D'Ambrosio, and it's my pleasure to bring to you this week's special presentation. Stock valuation is the process of determining the intrinsic worth of a company's shares based on various factors such as earnings, growth potential, and market conditions. It involves analyzing financial statements, assessing industry trends, and considering macroeconomic indicators to estimate a fair price for the stock. That seems like a heck of a lot of work, but lucky for us, VectorVest does all that work for you. And here we are 50 years later almost, and we have all of this information right at our fingertips. Dr. Delito first started to develop the VectorVest system back in 1978, and if you haven't heard the story before, I would suggest to read Dr. Delito's little green book called Stock Strategies and Common Sense, where he goes through kind of the genesis of the VectorVest software. But I wanted to take a little time here to read an excerpt from that book. This is from the preface. He says, "The Forbes information was good, but it did not tell me what I wanted to know, i.e. how to value stocks." The Forbes magazine he was looking at was one of the publications that he was receiving in 1978, and he was snowed in that day and wasn't able to leave the house, so he decided to kind of go through that magazine and see what types of information that they offered. He goes on to write, in his classic book, The Intelligent Investor, Professor Benjamin Graham said to favor undervalued stocks. I did not have access to the data he did, so I had saved whatever information I found on stock valuation. The key to what I was looking for was in an article I had torn out of an old issue of Forbes magazine. Associate Professor David Dodd, co-author of How to Analyze Stocks, said that a stock's fair value could be assessed by comparing the earnings yield of the stock to the interest yield of a bond. This comparison was the basis for a formula I crafted called the Quick Value Estimate, and it is detailed in Chapter 4 of this book. He says, by the end of the day, I was comparing the value of each stock in the Dow Jones Industrial Average to its prior closing price. I finally had a way of identifying undervalued stocks. And when Dr. Delito really started to develop the VectorVest system, value was the first thing that he wanted to know. There were also a few other things that he not only wanted to know, but felt every investor should know. Again, number one, what their stocks are currently worth, how safe are they, and when to buy, sell, and hold. And from here, the VectorVest system was born. Stock value, as computed by VectorVest, tells you what a stock is currently worth based upon its earnings growth rate, profitability, and two factors that aren't commonly included in value, and that's inflation and interest rates. Value increases when a company's earnings increase, when their growth rate increases, when they become more profitable, and higher valuations occur in low inflation and low interest rate environments. We want to favor stocks that are undervalued. If price is less than the value, a stock is undervalued. When price is more than the value, you're paying a premium. Stock is considered overvalued. Not necessarily a bad thing all the time. We'll get into that in a moment. But we do want you to favor undervalued stocks. So let's get into the VectorVest program. And value, just like anything else in VectorVest, you can consider as information. It's not data. The data that is used to determine value is earnings growth rate, it's interest rates, inflation, profitability. That is the data that if you were to try to compute value of a basket of stocks and a list of stocks, you would have to crunch those numbers. I'm not sharp enough to do that. If you are, fantastic, but you don't have to. VectorVest does all that work for you. Remember, we provide you folks with information, not data. We take data, turn it into useful, valuable information. What we're looking at here is the UniSearch tool, and I have 3 lines in here, 3 parameters that I like to include in most searches that I create. It's not the end-all, be-all, or the holy grail of searches. It's just some things to consider. Looking for price greater than $10, average volume greater than 500,000 shares, and I want the stock to be in an uptrend, RT greater than 1. If the first piece of analysis that we're interested in is finding stocks that are undervalued, it's as simple as using a sort. So the parameters here are going to find stocks that meet that criteria. I'm going to sort that list. I'm not sure how many stocks will be returned, but I want to sort that list and bring to the top the stocks that are the most undervalued. So I'm sorting the list by value divided by price. Value divided by price descending. This is going to return to the top of the list the stocks in the entire database of 9,200 plus, the most undervalued stocks. Quick run of that search. American Airlines, a couple of companies here that we're familiar with. Atlas Energy, Royal Caribbean, Carnival. Cruise lines have really recovered nicely after the COVID debacle back in 2000. And that industry, the cruise industry, just the leisure industry in general, was one of the industries that were hit the hardest, right? Everything shut down. Nobody went anywhere. Nobody went on vacation. Carnival, Royal Caribbean, a lot of these cruise liners lost a lot of money, but they've recovered nicely. Let's just take American Airlines, for example. We got a price of $14.78. That's as of yesterday's close. And we feel the company is currently worth, the stock's price is currently worth $25.96. That stock, American Airlines, in the list that we have here that meet the criteria above, is the most undervalued. Atlas, Royal Caribbean, Carnival. So while value isn't necessarily a signal, it's very, very crucial information for our stock selection process. And I think it always begins with value. We can move along here from left to right and look at RV. And it's no surprise that these stocks that are so undervalued have excellent RV ratings, well above 1. A lot of them have RSs just right around 1, a little bit below 1. But you can look at their earnings growth rate, earnings per share, earnings yield. Again, these are all a couple of the factors that we include in our value calculation. By the way, if you want to know more about the calculation of value, that would be in Dr. Delito's Green Book in Chapter 4. With earnings growth rate, these are all fantastic figures here. 24%, 31%, 60%. You want that number, the earnings growth rate number, it's a forecasted earnings growth rate, to be greater than the current sum, always, of interest rates and inflation. Right now, that's about 8.5%. So all of these companies are growing their earnings, or we're forecasting them to grow their earnings, at a faster pace than the current sum of interest rates and inflation. So that's good. Look at these RV ratings. Again, they're all the RTs. All of these stocks are in uptrends. Now, I'm going to graph them. And again, while value isn't necessarily a signal, what I want to see when I'm buying a stock, particularly for the long term, is growing value. And you can see that on a chart. Can't really see that in the UniSearch tool or the stock viewer. You're looking at a fixed data point there. But when you look at a chart, you can see, is earnings growing? Here with American Airlines, you got earnings at the top, you got earnings per share here, and you have earnings growth rate at the bottom, and of course the share price. So we're looking at a 1-year chart. I want to look at a 5-year chart. American Airlines, the airline industry, another industry that got hit pretty hard during COVID. You can see the value of the stock drop quite a bit. We had it valued at the bottom there at about $13. At about $1 with a share price of about $13. At the time, with the amount of money that these airlines were losing, that's going to have a direct correlation to the value of a company, right? Look at the earnings per share figure there in blue, how it just continued to steadily drop. They were losing boatloads of money during that time, but they've also recovered nicely. And it's nice to see that the value of the stock has as well. And over the last 4 months or so, value has been increasing. I don't like to look at stocks with not a ton of data, but something like Royal Caribbean. If I'm interested in buying an asset, and that's what a stock is, I want to see value growing. I also want to see price growing, and the current market price, of course, appreciating the growth of the company and the increase in value of that company. Royal Caribbean, perfect example. Earnings per share looks great. Forecasted earnings growth, we're talking about 42%. This is, again, a 5-year weekly chart. But price is growing, value is growing. The trajectory of value is exactly what you want to see. So these are the stocks that we want you to favor. Stocks that grow their earnings consistently, that do so quarter over quarter, year over year, and whose value continues to increase. DHT, another one. Apollo Global. Look at that value trajectory. So those are the stocks that we want you to favor. TDW, Tidewater, stocks that are undervalued. I mean, we always, again, want to buy undervalued assets. I'd rather pay less for a house than what they're asking for or what the fair market value is currently. So with anything that we're buying, we're always trying to get a discount. Just a simple price to value comparison. We're able to determine whether a stock's price is undervalued, whether I'm getting a bargain, or am I paying a premium? And earlier, one of the slides read that if a stock's price is over its value, it's considered overvalued, and you are paying a premium. And I said, well, sometimes that's not so bad. Why isn't that so bad? Well, let's take a look at the S&P 500 watch list. This list, of course, when you select it, is automatically sorted by VST. But there are a lot of stocks in the S&P 500 that are overvalued. NVIDIA, for example, the top VST stock in not only the S&P, but the entire database. Let me take off the stream. It's got a current price of about $924. We think it's worth $793. So we're talking about $130, a little more than 10%. So the stock is considered overvalued. But as we know, it's a fantastic company. It's an industry leader. People are willing to pay more for quality. And that's what you can consider NVIDIA, right? A quality company. Look at that relative value. Look at relative safety, RT, CI, earnings growth, $21.21 earnings per share. Okay, small dividend, but boy, best of breed here for sure. Now, if I graph NVIDIA, we're going to see that the price is over its value. And in fact, it actually just eclipsed the value. But is value growing? Is earnings growing? Earnings growth rate continuing to grow? By the way, Dr. DeLito felt that every 1 to 3 years, price and value will meet, whether price comes towards value or value comes towards price. And we can actually see that happen right here in November of 2023 when the price was about $477. Price consolidated there for quite some time, but value continued to grow. So again, while value isn't necessarily a signal, I think a good way to look at value in a couple of ways. You want value to be growing. You want the company to continue doing what it's doing, continue to grow their earnings, continue to reinvest in the success of the company. That will have a positive effect on value. When value and price eventually do meet, while it's not a signal, it's a great piece of information that, hey, maybe a stock was overvalued for a while, but it's come back down and it's now a fair value. I'm not going to be paying a premium anymore. If the stock is 50 and value is 45 or 55, I'm getting a pretty good price. So when value and price eventually do meet, I think it's a stock that you may want to consider now, especially if the stock was overvalued for so long, and it was. NVIDIA was overvalued for a while. Okay, still is as of the hard right edge, but value is growing, and that's what you want to see. Here's Decker Outdoors, another stock that's overvalued, but I'm not too concerned. People are willing to pay a premium. They are also best of breed within the apparel sector. Here's Meta. This stock is now overvalued. But during this consolidation period, when price and value eventually met, price was $312. Would that have been a good price or a good time to consider a long-term investment in Meta? It was overvalued for a while. Here's Progressive. Now this stock is undervalued. And again, it's the slope of the value indicator that I think is helpful, especially when you're looking at a chart. And most of these, Arch Capital, fantastic. Most of these have that favorable upward slope. If you come across a stock that doesn't, maybe price is rising, but value is dropping. That might cause you to say, maybe there's some other candidates out there for me to buy and hold a little bit longer term. But these are just great stocks, great companies. Again, it's that slope that's most important. Going back to the UniSearch tool, one last thing I want to leave you with. These are just 3 parameters here. Let's say you want to look at a specific list of stocks, maybe the NASDAQ 100. If I filter by a watch list, make that watch list equals, go to special watch list, go to NASDAQ 100. I can now look at the most undervalued stocks in the NASDAQ. AstraZeneca, Baker Hughes, PayPal, Coca-Cola, Alphabet, Meta. Let me go back over here. AstraZeneca, PayPal, Meta, Google. Now, watch what happens when we get a little deeper down the list. Honeywell, Applied Material, Ross Stores. These stocks are actually overvalued. Right? When the indicator goes below 1 here, when the value divided by price indicator goes below 1, these stocks here below are all overvalued. What does that tell you? That tells me that only about a basket of stocks, 10 stocks in the whole NASDAQ 100 that meet the criteria that I have above, making sure relative timing is above 1, only about 10 stocks or so are undervalued. And I said earlier that buying an overvalued stock isn't necessarily a bad thing. Paying a premium isn't necessarily a bad thing, only when you have favorable fundamental indicators. RV, RS, earnings growth rates that, again, exceed the current sum of interest and inflation. We, of course, want the stocks to be in an uptrend. High CI levels help as well. But if you come across an overvalued stock and the fundamentals are good, again, favorable RV and RS ratings, people are willing to pay more for it. And I think that's how you can interpret that type of situation. Now, if a stock was overvalued, let's say the price was $40 and the value was 20, but RV was low, RS is low, that's not a premium that you should be willing to pay. You might be okay with paying a premium for quality again. So this is just one way to look at value. We want you to favor undervalued stocks. The sort, I think, is going to be really helpful. Looking at value divided by price. Now, any list of stocks you go to, if I go to the viewers again, now we're still in that S&P 500 watch list, I can sort that entire watch list by value divided by price. First Solar, American Airlines, we saw these before, Royal Caribbean, Expedia, First Solar, American Airlines. So you're getting a nice bargain here in terms of what we feel the company is currently worth. Thank you, folks, for watching today. If you have any questions, of course, give our support department a call, or you can email us at support@vectorvest.com. Have a great weekend, everybody.